Let's start with our hypothetical country that has a simple economy with only households and firms. We see that households consume goods and services and provide the factors of production, which we saw earlier was land, labor, capital. And firms that produce goods and services hire these factors of production and pay incomes to households. There are two kinds of flows that take place between households and firms. The first kind are real flows, such as factors of production, land, labor, and capital from households to firms, and goods and services that firms provide to households. So these are real flows. The second kind of flows are monetary flows, such as incomes and expenditures on goods and services. So households spend on goods and services, and that's a monetary flow. In this simple economy with only two economic entities, we can see that households spend on goods and services that firms produce and receive incomes for the supply of the factors of production to firms. Let's further simplify this hypothetical economy. Let's assume that our hypothetical economy is an agrarian one. A typical income statement of a farm will look like this. This particular farmer receives money worth $1,000 for the sale of fruits and vegetables bought by households, and in turn pays out $1,000 for the factors of production. Assuming there are 1 million farmers in our economy, the national product will be 1,000 million. We can see that aggregate households buy 1,000 million worth of fruits and vegetables, and aggregate firms or farms in our case have produced $1,000 million worth of fruit. Since in our hypothetical economy we haven't introduced savings as yet, all the money earned by households will be spent in the consumption of fruits and vegetables. Therefore, in this two-entity closed economy, incomes received by households is spent entirely on goods and services, and hence aggregate income equals aggregate expenditure, and the value of goods and services produced by firms is equal to the value of goods and services consumed by households. And therefore, in our economy, aggregate expenditure equals aggregate products. And finally, we see that aggregate income equals aggregate expenditure equals aggregate products. So in our country, the aggregate income is $1,000 million that households earn for that year. They spend it all on fruits and vegetables. So the expenditure is $1,000 million. And the total production by farmers is also $1,000 million. Now, this is a simple economy, and one might argue that households in reality save a part of their income, and not all is spent on consumption. So therefore, let's look at a slightly more realistic world of savings by households and investments by firms. Let's assume in our slightly more realistic world, where households now start saving a part of their income, this would mean that only a part of the income that they receive goes into consumer expenditure. This also means that now firms receive less of this monetary flow from consumer expenditure, and they shell out more in the form of income. Therefore, firms fall short of money, since consumer expenditure minus income is now negative. In order to buy plant and equipment and additional inventories, firms now need to borrow money. This investment can be divided into capital investment or inventory investment. And we have seen the definitions of capital investment and inventory investment before. In the real world, the savings by households goes into the financial markets, either into stocks, bonds, deposits in banks, etc. Firms, on the other hand, need to fund their cash shortfall, and hence borrow from the financial markets. This market where firms borrow and where the households' savings flow is called the capital markets. It is the capital markets that link savings and investments. So in this slightly more realistic scenario with the addition of savings and investments, we see that firms need to borrow for investments to fund the cash shortfall and receive consumer expenditure from households. Firms pay out incomes, so now households receive incomes and pay out consumer expenditure plus savings. Let's add an additional entity to our hypothetical world, the government. The government, like households, consumes goods and services that firms produce, but perform two additional tasks: collecting taxes and paying benefits and subsidies, also called transfer payments. Since the collection of taxes is a monetary flow from households to governments, and the transfer payments are a negative flow from the government to households, we can net these two to call it net taxes, or simply we call them taxes, and can be assumed as taxes less transfer payments. With the addition of the government, we see that now firms receive consumer expenditure plus investments plus government spending and pay out incomes. Households receive this income, and the outflows from households are savings plus consumer spending plus taxes. The total expenditure in this more complex economy is consumer spending plus government spending plus investments. Lastly, let's bring the rest of the world to make our hypothetical economy close to the real world. The rest of the world is the last economic entity that is required to bring into our hypothetical world to make this as close to a real world as possible. Domestic firms buy imports from the rest of the world in exchange for money and sell exports in exchange for money to the rest of the world. Exports minus imports is called net exports. Now, when we look at outflows from firms, we see that firms pay incomes to households plus they pay for imports. Therefore, the total outflows from firms now becomes incomes plus imports. With exports introduced in our new economy, expenditures now becomes consumer expenditure, consumption expenditure, plus government expenditure, plus incomes, plus exports. But since we know that income equals expenditure equals products in our economy, we see that the left-hand side of the equation, which is income plus imports, equals C plus G plus I plus EX. Or therefore, incomes equals C plus G plus I plus EX minus IM. The right-hand side of this equation, C plus G plus I plus EX minus IM, where EX minus IM is net exports, is now the total expenditure in our economy. This aggregate expenditure is what we know as the gross domestic product and is a measure of the aggregate economic activity for that year. If the goods and services are measured in current year's prices, then it's called the nominal gross domestic product. But if they are adjusted for inflation, then it's called the real GDP. Because goods and services are valued at a base year's price. We will discuss real versus nominal gross domestic product later in the inflation chapter. To summarize, we have seen that in our hypothetical world, income equals products equals expenditure, and therefore, in the real world, the gross domestic product is also measured by either of the three methods. In the expenditure approach, the gross domestic product is measured by aggregating consumer expenditure, the C in the equation, investment spending, the I in the equation, government spending, the G in the equation, and net exports, the EX minus IM. In the income approach, statisticians add the incomes generated from the factors of production, salaries, interest, rent, and profits. Since profits are the net of depreciation, and by definition, we have seen that gross domestic product doesn't account for depreciation. Depreciation is added back to the total figure. Lastly, in the products approach, the aggregate is computed by measuring the value of output of each industry and then aggregating. We now understand how GDP is computed, and by modeling the real world with our hypothetical world, we understand its components: consumer spending, government spending, investments, exports, and imports. This is the foundation of our economic map, to which we will keep referring to in order for us to make the connections between the economic indicator releases, the economic entities, the GDP components, and the financial markets. Before we begin with the economic indicators, we first need to understand the historical context of the gross domestic product figure to understand what high growth, sustainable growth, and recession is. We need to know the historical context of growth, inflation, and interest rates, because when any economic data is released, we can look back to see how the central bank had reacted in the past when confronted with similar data. So if sustainable growth had been, say, 3% historically, and if the current data indicates that the growth is far ahead of 3%, let's say more towards 4.5%, then we can look back and see how the central bank reacted in the past by either raising interest rates or by any other direct intervention in the foreign exchange markets. By looking back in the past, we can gauge whether they raise interest rates gradually or was it an aggressive intervention. We can also see what other economic factors were during periods of high growth or low growth. So in order to make predictions on the future of economic growth, inflation, and interest rates, we need to have this historic context for our country of interest. This is more of an art than a science, and if one masters this art, he or she could have the potential to make big money.